A perfect time to talk with Alan Ruskin of Deutsche Bank. Alan, I don't even know where to begin except the strength of your recent research note. Bring it up here, note of the day. This is strong language from Ruskin. He's usually a gentler guy than this. We're trying to bring that up right now. Bring up that note of the day. It's written in German. I had to translate it. There it is. The U.S. recovery is between the second and third worst on record, but even this observation is flattering. Like my waistline, since the recovery must be placed in the context of the largest post-World War II cumulative decline. Is that bad?
It is bad. If you place it in the context of the amount of stimulus that they've thrown at the economy,
Trillions.
then yeah, absolutely. And I think the other worrying aspect right now, of course, is that it seems like the recovery is losing momentum. So that's probably the bigger problem. And we're not actually building towards stronger growth, but if anything, I think we're seeing the economy slip slightly in terms of growth rate.
Soft patch is a phrase I hate. I've never really understood what it means. We're maybe not a recession, but we really can't make the whole dynamic system work on 2% GDP, can we?
Well, we're not going to get unemployment down in any meaningful way, and we're not going to solve a lot of the other problems. So again, the fiscal situation becomes that much more problematic if we have 2% growth. I mean, we're not going to grow our way out of a fiscal problem, and instead, in fact, the fiscal problem will probably exacerbate growth. So we'll have to have tighter fiscal policy, in turn meaning weaker economic growth. So you get into that kind of negative spiral.
What does the Deutsche Bank call? What does Peter Hooper and Thomas Mayer and the team, when they look at the United States, what are they observing?
They're fairly optimistic that the Fed chairman is correct, that the Japan supply chain problems have slowed the economy substantially, perhaps by as much as 1%. So we could actually see growth rates above 3% again, really pretty much driven by that particular aspect. And then obviously with oil prices down, like we've seen today, that would be very, very helpful.
That would be very, very helpful. I mean, it cuts both ways, doesn't it? It hurts investors that are long commodities.
Yeah, no, but I think, I think we're going to have to concentrate on what it means for the economy, of course. And yeah, it's great news. I mean, it looks very political what they've done, of course. It does look like there's a sense in Washington that the Fed is stymied in terms of monetary stimulus, as we saw yesterday. Yes. They feel quite boxed in, even in terms of moving towards, say, QE3. And in addition, the fiscal situation means that you're going to have some fiscal drag, potentially large fiscal drag ahead.
I want to talk about fiscal drag in our next block. Look at this chart. I'm so glad you brought it up. ISM manufacturing prices paid. And what you're saying here, this is a really important nuance, folks, why Ruskin's so well known. China drives the bus in that in previous slowdowns, we controlled the marginal commodity price. We don't anymore, do we?
I think that's hugely important, in fact. So the United States was usually in a very fortunate situation of a slowdown, in turn driving lower commodity prices, in turn being supportive for the economy. You don't have that natural offset. So that's just one more factor. Put it to fiscal policy.
Hands here. Come on, get the camera. Camera guys are slacking off. Okay, our economy comes down, and we used to just have a self-stabilizing. Commodities would come down with it. And that's broken. We go down, China goes up, oops. Right?
Exactly. So, well, what do we do then? We just dump some extra oil, stockpiled oil on the market.
France dropped 2% today. Well, there when we see and Brent crude right now, 107.37. Have you modeled in cheaper oil prices? I mean, that does come to the rescue if it's NYMEX 80.
Yeah, I don't think people have modeled in these kind of declines. I think there's this expectation that if the U.S. economy does slow, then the rest of the global economy is probably going to slow as well, right. And therefore oil prices will come down to a degree. But they didn't factor in, I think, this latest exercise in terms of additional supply. That seems like it is likely to kind of cap the upside on oil.
I'm going to get a 2-year real yield chart up. Here's a 10-year. Bring up the long-term view of the 10-year. This is a weird chart, folks. Usually we do short-term yields. U.S. real 10-year yield, and it's down below that yellow line just a bit right now. I mean, this is an accommodative. I mean, Bernanke's throwing everything at this he can.
Absolutely. And, another level, you could say, well, the real yield is actually reflective of lower rates of return in the economy. And that's why we need these very low real yields to equilibrate as such. So it's also a sign of weakness in terms of the economy as well. But, one of the oddities I think you're seeing in this market today, of course, is that no QE3 is spelling lower yields because it's risk off. Equities down and bond yields going down. So it's something a little perverse about that.
We were going to bring up a terminal shot here. This is absolutely killer. The real two-year yield, I can almost say I've never seen this. Here's a decade of the two-year yield adjusted for inflation. And Alan Ruskin of Deutsche Bank, this is how unusual this drop is. We saw it Lehman, Bear Stearns, and such. How are we equating the crisis now to what we saw back here? What's a similarity to 08-09?
Yeah, it's an interesting question, Tom, as to whether one should be focusing on real yields or nominal yields. I think...
I totally agree with that statement. Which one matters?
Yeah, the average viewer would say, look here, I don't pay my mortgage in real yields, really. I play the nominal yields. So I think nominal yields are ultimately more important. But you could say that the reflationary effects are showing up in terms of a drop in real yields, and that somewhere in the mix there, that's actually helpful in terms of stimulating and shifting... And really shifting people's asset portfolio towards riskier assets.
I mean, let's say we get Brent under 100. When does a disinflation, deflation watch start again if oil's coming over?
Well, I think that, in many ways that would be, a good thing, really. So if we started to see inflation expectations come off significantly, and they have come off a little bit of late, then the Fed would actually feel, wait a minute, actually we freed up a little bit here. And the market, I think, would feel a lot better about it. And there would be some backstop, and the Fed would perhaps be able to move towards QE3 more freely. I think the bar is still quite high towards moving towards QE3, but they won't be stymied completely by higher inflation.
This chart, I've gotten so much mail on this chart. Thank you for the letters of Greece particularly. This is fiscal drag. There's Greece GDP rolling over with all of their challenges and the 4-year moving average below zero. I've never seen anything like that. You're concerned as well about fiscal drag here, not as dramatic as that picture, but nevertheless, there it is.
Yes, no, I think the whole story about fiscal drag globally is significant. I mean, we're seeing fiscal drag coming up on the rise in the United States to a greater degree than I think we've ever seen, really. So I've gone back to data through to the 1970s, and the kind of fiscal drag that we could see over the next, say, 2, 3, 4 years could be as large as anything we've ever seen in this country.
Very quickly, when will the Swiss National Bank intervene again? What a difficult position.
They've been burnt terribly, really. And I think the important thing, I think, is that the Swiss franc is showing, in fact, that you're seeing the trade balance remarkably resilient. You're seeing exports remarkably resilient. So the Swiss franc is not nearly as overvalued as a lot of people think.
They can just keep driving it down and driving it down as the...
Well, I think there's going to be levels at which, the Swiss are not going to be able to export a whole host of different things, from pharmaceuticals to watches. But I think there's, so far, the evidence has been that the Swiss competitiveness is holding up really shockingly well.